Hi everyone, Chris Stanton here from the law firm of Klump & Stanton in Mendota Heights, Minnesota. Today we're going to talk about how estate tax works on a federal level and also how it works on a state level. In addition, I'll inform you as to what changes have occurred tax-wise in Minnesota and how we can all take advantage of these changes. As you can see from the first page on your screen, you can see the question does come up: does everyone still pay estate tax in the year 2014? Well, just as before, not everyone has to pay estate tax. It depends upon the size of your estate. Now, the misconception for movies and television is in the movies, what they portray is that when people inherit money, they then, of course, have to pay an inheritance tax. Everybody knows that. Well, that's not the way it works. It's the estate of the deceased that pays the tax. The beneficiaries get what's left over. Now, not everyone has to pay estate tax. It does depend upon the size of your estate. Now, what do they calculate in determining whether you have an estate big enough to have to pay estate tax? Well, they look at your home. They take into account your bank accounts and your motor vehicles, and if you have any boats. They also take into account your retirement accounts, as well as, and it's overlooked oftentimes, life insurance. Life insurance is included in your estate in calculating whether or not you have to pay estate tax. Now, Minnesota, if you're a Minnesota resident, you have two different types of estate tax to pay attention to. On the one hand, you have federal estate tax or death tax. Now, this exemption is fairly generous, in excess of $5 million, meaning if your estate is below $5 million, you don't have to pay estate tax. For most of us out there, that's the situation, so you don't have to pay attention at all at the federal tax. The state of Minnesota, however, isn't quite as generous. They only allow you to pass $1.2 million. Now, that's actually an increase from last year. In 2013 and the first part of 2014, the state of Minnesota only allowed people a $1 million exemption. Anything over $1 million was subject to a tax, and in some cases at 41%. They've made some changes to lower that significantly. That's a big advantage for us Minnesotans. Now, let's take a look at the numbers a little bit closer. As I mentioned before, there's federal tax, and this federal tax is $5.3 million roughly. If you happen to be lucky enough to be over that amount, you need to pay attention to what you're doing on a federal level, because if you did have to pay a tax, it would be at a whopping 40% on anything over that amount. The good news is, if a husband and wife use their exemptions effectively, and they each get one of these $5.3 million exemptions, then they can pass in excess of $10 million. And that's pretty darn good. So you want to make sure that if you are lucky enough to be over the 5.3 level, you do have proper planning, and we're going to talk about that coming up, in order to make sure you secure your full $10 million of exemptions. Now, many times what people will do, if they do have big estates, they'll make gifts of $14,000 to their children or grandchildren or what have you, and they think that that's all they can give. Well, that's what they can give without affecting their $5.3 million exemption. In other words, they get the free $14,000. Well, what happens if an individual gives, say, $100,000 rather than $14,000? That would mean they're $86,000 over the allowed amount, right? Well, many people are of the opinion or believe that you then have to pull out your checkbook and write out a check to the government because you went over the amount, and that there's a gift tax. Well, that's not actually the way it works. If you give more than the $14,000, in this example that I'm using, you gave $100,000, you're $86,000 over the allowed amount. You would just simply deduct $86,000 from the $5 million exemption that we just talked about. So you don't pay a gift tax out of pocket. It just is deducted from your $5.34 million exemption. So keep that in mind. Now, on the state level, Minnesota isn't quite as generous. And for more people, for sure, than on a federal level, this tax comes into play because the exemption is only 1.2 million. Now again, with life insurance included, many people believe that well, I don't have any tax problems. I only have 500,000 in assets or whatever it may be. But if you do have insurance policies, you need to tack it on to whatever your net worth is to determine whether you have to worry about it. If you're above the 1.2 million, a simple will isn't going to cut it in order to make sure you use both of your exemptions. So make sure that if you're over that 1.2 mark, that you use both of the exemptions, because between a husband and wife, they'd be entitled to pass almost $2.5 million onto their family without estate tax. If you do pay estate tax, it will now run from 9 to 16% on the state level. It's not quite as bad as it used to be, but still, you don't want to have to pay tax when you don't have to. Now, how does this work? Well, let's imagine or take into account the two people in front here. We have a husband and wife, and they each have one of those $1.2 million exemptions. And the way to take care of it or make sure that they use them properly is understand that in order to use them effectively, you have to have properly prepared documents while both of them are alive. In other words, in order to be able to use John's $1.2 million exemption and Jane's $1.2 million exemption effectively, they must have provisions written into their will or into their trust, creating what is called a CreditShelter Trust. These provisions need to be written into the estate planning documents prior to the first death. Okay, well, how does this work, really? Well, the best way to understand, and I've always been one, if you give me examples or draw me pictures, it helps me understand. So I'm going to give you a couple of examples, and then I'm going to show you the right way to make sure that you have your estate planning documents in proper order. Now, let's look at an example here. We have John Doe at $750,000. We have Jane Doe at $750,000. Combined, they're at $1.2 million. They're above, or I should say they're at $1.5 million. They're above the $1.2 million mark, so they need to make sure that they use both of their exemptions effectively. Now, typically what happens is if husband dies, everything goes to the wife. And that's fine on the first death, as you can see, because there's what's called an unlimited marital deduction. John can give Jane an unlimited amount and there wouldn't be any tax. The problem is, in this example, if Jane is worth $750 and she just received $750 from her husband, she's now going to be worth $1.5 million. And again, as long as she's alive, that's not a problem. But one day she dies. Well, that's when there's the knock on the door from the government. They're going to say, well, what's Jane's estate worth? Well, she's worth $1.5 million. Well, what's her exemption? Well, her exemption, as I mentioned before, is 1.2, leaving $300,000 taxable, and that causes a $45,000 unnecessary tax. Now let's look at example number 2. Here we have John worth $1 million and Jane worth $1 million. And again, I can't stress this enough. That includes life insurance. John dies. Everything goes to Jane, and that's fine on the first death because why? There's the unlimited marital deduction. So Jane had $1 million. She received $1 million from her husband. She's now going to be worth $2 million. She goes along. One day she dies. Well, that's again when the knock on the door comes from the government, and they'll say, well, what was Jane's estate worth? Well, she was worth $2 million. Well, what's her exemption? Her exemption's $1.2 million. That leaves $800,000 taxable, and that causes a $128,000 unnecessary tax. Well, I just got done telling you a few minutes ago, between a husband and wife, if they use their exemptions effectively, they can pass $2.4 million. This was only a $2 million estate. What happened? Well, what happened is when John died, he just piled everything right onto Jane's estate, pushing her up over the 1.2 million mark. And anything over 1.2 million is going to be subject to tax. So you need to keep that in mind. Well, what needs to be done in order to make sure that we use both of their exemptions effectively? Well, what needs to be done is we need to have properly prepared documents. You need to have wills or trusts that say something to the effect that if John dies, everything would go to Jane, but this time you have a provision in. It's called a disclaimer provision. So what's going to happen is, my handwriting isn't very good here with the mouse, we're going to disclaim a portion of the assets from Jane's estate into what is called the CreditShelter Trust. This is kind of an overflow trust. Anything that's going to put Jane over that 1.2 million mark, she's going to want to put into this shelter. Okay? Now, she is going to receive income for life. She's going to have principal available if she needs it. Okay? So what will happen is John passes, gives everything over to Jane. Jane says, well, I know I can go to a max of 1.2 million. So she would accept 450 of the 750 John gave to her, bringing her up to that 1.2 million mark. She'd disclaim that remaining 300,000 into the CreditShelter Trust. And as I mentioned, Jane's going to be entitled to the interest income from the 300,000, plus the principal would be available if she needs it. She would have 9 months after the husband dies to make the decision as to how much, if anything, goes into this CreditShelter. So it's not that you put something into your will or trust that binds the spouse to putting this money there. Certainly you need to take a look at what the size of the estate is at the time of the first death, as well as what the exemption is, and then determine if you use this shelter trust. Okay? So this would then go on for the rest of Jane's life until one day she dies. Well, that's when the knock on the door would come, and they'd say, well, what was Jane's estate worth? Well, they'd say, well, she was worth 1.2 million. Well, what's her exemption? Well, her exemption's 1.2 as well. That leaves 0 taxable, and as a result, 0 tax. So if you recall before, it was, I think, it was roughly $45,000, $46,000 on the same size estate as before. Now, let's look at the million and the million. Again, John dies, gives everything off to Jane. Jane says, well, wait a minute, I know I can only go to 1.2 million without tax upon my death, so she accepts 200,000, disclaims the other 800,000. And as I mentioned, anything that was disclaimed into the CreditShelter Trust, she's going to be entitled to the interest income for life, plus the principal is going to be available if she needs it. This is going to go on for the rest of her life, again, until one day Jane dies. That's when the knock on the door from the state of Minnesota comes. They say, well, what's Jane worth? Well, she's worth 1.2 million. Well, what's her exemption? Again, her exemption's 1.2 million. So there would be 0 taxable, and as a result, 0 tax. So all the monies that Jane had in her direct control would go to her beneficiaries, and then the proceeds from here would also go to the beneficiaries as well. Okay? And in this particular case, if we look back, I think that we were looking at roughly $128,000 that we're saving on the same size estate. So you need to make sure that you use your exemptions effectively when you have an estate in excess of 1.2 million. Okay? Now, how does the CreditShelter Trust work? Well, it's a provision that is written into the will or the trust prior to the death of either the husband or wife, giving everything to Jane, but gives her an option to disclaim assets into the CreditShelter. Upon John's death, Jane has up to 9 months to make the decision. Assets that are disclaimed will be owned by the CreditShelter Trust, and then you just acquire very easily a tax ID number for it. Jane will receive all the interest income from the disclaimed assets, plus have the principal available if she needs. Upon Jane's death, assets that are in the CreditShelter Trust shall go to the beneficiaries, estate tax-free. So, what you need to take from this is that if your assets plus life insurance are in excess or coming up on 1.2 million, you need to have a little bit better prepared will than your run-of-the-mill simple will, and you need to have provisions in there that make use of both the husband and the wife's exemptions. That will do it for today. Hopefully you've learned a couple of things. If you do have questions or you need clarification, there's my relevant information on there. I'll be happy to talk to you and explain or clear up anything that might be on your mind. So until next time, have a nice day.